yesterday, and we we had a tough month of September. Um, the month of October has gotten off to a decent start. MTD stands for month to date, so that is for the 5 days of October, and you can see that the markets are up 5 plus or minus %, but that's after a very difficult September. Um, Year to date, you see double-digit losses still for the equity and bond market indices. The S&P 500 was down about a little less than 20% through yesterday. If we looked at that through the end of September, it was down about 25%. And so that is defined as a bear market correction being down more than 20%. Mid-cap stocks were down 16.5 through yesterday. Small cap was down a little more than 20. From a style standpoint, the growth part of the market has given up the most value versus value. So the Russell 1000 growth index was down almost 27, and the value index was down half of that, down 13%. And then on the international front, both developed and emerging markets were down a little bit more than 24%. And the biggest troublesome issue has been the return. Not the equities have lost the most, but typically when we lose money in the equity market, we often have a corresponding offset and better returns coming from fixed income. And that's because typically equities will have negative returns in a poor economic environment. And the response of the government in a poor economic environment is to drop interest rates, and that generally results in positive bond market returns. But the reason the equity market has traded down is because of the rising interest rate that we've been in. And the rising interest rate is a function of the inflationary impact as a result of the stimulus that was thrown at the market in 2020 and 2021. And as a result of inflationary pressures, the government has had to precipitously increase short-term interest rates to try to curb these inflationary pressures. So that has caused the worst bond market on record. In terms of in the period of time that we've experienced from the beginning of the year. Investment grade bonds are down 14.1%, and the high yield part of the bond market was down 13.2%. So the combination of both negative returns in equities and fixed income, there has been basically no place to hide. And what we've also seen is a big difference in performance in the individual sectors of the equity market. Down below, we look at the sectors of the S&P 500 index, and the range of returns is just enormous. So depending upon where managers were basically allocating within the broad equity market, had a material impact on performance. And you can see that, like the energy part of the market, a 52% return through yesterday. So that has been the best place to be. But you also have to note that over the last 10 years, energy is the worst performing part of the market with only a 4.7% return. And then the most difficult part of the market, like a group like communication services, down almost 36%. And you've had challenging results in publicly traded real estate, information technology, and consumer discretionary stocks, which were all down more than 25%. And just for information, we've been showing what are called the FANG stocks, and these are the stocks that led for much of the bull market, where growth led. And many of the FANG related stocks have given up the most amount of value in 2022. Now, one thing I want to point out is that, and I haven't been including this on this chart in the last couple of meetings, but I looked at it when I was running this, and I thought it sort of told an interesting story where, remember, leading into 2020, we finished 2019 at market highs. The S&P was at all-time market highs, and it peaked on February 19th of 2020. That was just before we had the negative impact of COVID. And from February 19th to March 23rd of 2020, the market lost 33.79% in a 6-week period of time. But what's interesting is that from the market high on February 19th of 2020 until yesterday, the S&P is actually up a cumulative amount of 16.5%. So, what I think of is that if I was sitting here with you on February 19th of 2020, and I said, for the next 2 years, we are going to be impacted by a global pandemic, and a lot of us we're going to be staying at home for the bulk of the next 2 years, and there's going to be all sorts of challenges. And if in that same breath I said on October 6th of 2022, would you be happy with a cumulative return for the next 2.5 years of 16.5%? And by the way, we're coming off of a market high right now. I think all of us probably would have said we'd take 16.5%. But the problem is that we got way overextended. At one point, at the end of 2021, the S&P 500 was up, over like 120%. And, even from the market bottom on March 23rd, the market still has returned, over, 80 to 100%. So I know that the markets have been challenging, but I think the long and short of it is that we were living in a period of excess, and the excess was driven by low interest rates and a tremendous amount of government stimulus. And, that has then resulted in these inflationary pressures. But we are basically giving back some of the excesses. It's also worth to note that through October 5th, when you look at the last 10 years in domestic equities, the S&P has still returned over 12% per year, including the most recent pullback. And you compare that to a 96-year average for the S&P of roughly 10%, we're still ahead of the 96-year average. And growth over that period has returned, over 14%. So, this period over here is no doubt really difficult. But unfortunately, we are giving back some of the excesses that we experienced over the last 2 years. Hopefully, the bulk of the challenging results are behind us, and hopefully we will go more sideways and eventually go up. But I think it's going to be bumpy until we have some sort of positive impact on the inflationary pressures. And I think the government, will still be diligent in raising rates until they see some sort of positive impact on those inflationary pressures. I included 2 other special exhibits here, which sort of showed the magnitude of this interest rate increase. The green line here is the Treasury yield curve on September 30th of 2021. So you can see short-term yields were close to zero, and long-term, the 30-year bond had a yield of a little bit more than 2%. And you can see then the blue line is the yield curve on September 30th of 2022. And it's one of the most significant rises in interest rates in a relatively short period of time. And the numbers in the black boxes is the level of interest rate increase for the corresponding part of the Treasury market. And so like the 20-year Treasury over this 12-month period of time has gone up by more than 2% in yield over that period of time. And the highest level of yield increase has been in the intermediate portion of the yield curve. And one other chart I put in here is we ran the returns for back to 1976 for the S&P 500 and the Bloomberg Aggregate Index. And the S&P returns are on the y-axis on the left-hand side, and the bond market returns are on the x-axis, the bottom part of the chart. So when you look at year-to-date 2022, you have a negative return from the bond market of 14.6%. And you have a negative return for the equity market of negative 23.87%. So all the other calendar years going back to 1976 are over here toward the right. We've never had a year over the last almost 50 years where we've seen negative returns coming from equities and fixed income, and particularly to this magnitude. We've seen negative returns coming from equities, but like 2002, we had a negative return of more than 20%, but the bond market was up over 10%. 2008, we had a negative return of roughly 37%, but the bond market was up, a little bit more than 4%. So very unusual year in 2022. I'm gonna shut up for a minute and see if anyone has any questions. No? Joe, that's my commentary right now on the market environment.
Fine. I was going to suggest that gives us something to talk about in the executive session as we go back over policy. And with that pretty much closes out the general session for now. What we are about to go into is to be handled in closed session under the exemption provided for managing public funds. And so with that, I will close the general session. Nikki, do I need a vote for that, or may I just proceed?
We need a motion, sir.
So I'll start the motion off to move into general session. Do I get a second?
Second.
And all in favor? Aye.
Aye.
Opposed? No one opposed.